Hi, everyone, and welcome to our lecture on debt. Starting out, we need to talk about what debt is. Simply stated, debt is money you owe to another person or business. And typically, we think about debt as being something that is always bad and should be avoided. But that isn't necessarily the case. While you always want to pay that money back, debt can also be helpful. You can take out a loan for a home, for your education, or for a business investment. Debt can help you to achieve goals in your life. However, you want to avoid taking out loans or using credit cards for things you don't need or aren't going to follow through on. Say you go into debt for a new car just to show off to your friends and neighbors, or you take out a student loan for a degree and then you don't finish school. Debt can be helpful when you have a specific goal in mind and a plan for paying off that debt. There are two different types of debt you should know about: secured debt and unsecured debt. Secured debt has an asset attached as collateral. This means that there is something that can be taken away. For instance, if you have a home mortgage loan and you consistently do not make payments, the bank can repossess or take away your house. Similarly, if you have an auto loan, the car is attached to that debt as collateral. Pawn loans, rent to own items, and secured credit cards are other forms of secured debt, and we'll talk about those later on. Unsecured debt does not have an asset attached to it. For instance, if you take out a student loan and do not make payments, they can't take away your education. Rather, the debt can go to collections where the lender may take legal action to receive that payment from you. Most credit cards and medical debt also fall into the category of unsecured debt. However, not everyone will qualify for a loan. If you have bad credit, which we'll talk about in the next lecture, or if you have no credit at all, a cosigner might be needed. When someone cosigns a loan for someone else, they are called a co-borrower, and they assume the same obligation to pay the debt as the primary borrower. So even if they are not the ones going to school or buying a house or plan on being involved in the payment process in any way, they have the same obligations, which means that if that person doesn't make payments, this person is also responsible. You owe the money you co-signed for, even if you don't receive any of it. This means that the cosigner's credit score can be impacted negatively if the primary borrower is delinquent, meaning they don't make their payments on time, or if they fail to make payments altogether, which can impact the cosigner's ability to get future loans. So be careful who you cosign with and make sure to make your payments on time if you have someone who has cosigned a loan for you. So, we talked about student loans in the first lecture of the course, but as a reminder, federal student loans are loans that are taken out from the government. And these loans, compared to private entities, usually offer the most flexibility in repayment options. Remember that there are fixed payment plans where a specific amount of money is paid each month, extended plans where a smaller amount is paid over a longer period of time, usually resulting in greater interest paid, and then graduated, where greater amounts are paid over time, assuming the individual has had time to find a good paying job. When repaying federal student loans, on time payments and being in good standing with the loan company can help you to qualify for different repayment options that fit your needs. Alternatively, there are private student loans. These may be made by independent financial institutions, state agencies, and sometimes schools themselves. The main thing to know about private loans is that they have variable interest rates, meaning they can fluctuate. Depending on the economy, the interest rate might be lower than it would be with a federal student loan, meaning you are paying back less money. But sometimes the interest rate is higher, leading you to pay more out of pocket. These loans also tend to be less flexible in terms of repayment options, so it can be more difficult to change how you are repaying or to file for forbearance or deferments if something happens and you are unable to make payments. While you are likely most familiar with school related debt, there are other types of debt to be aware of. Medical debt is from not having insurance or from insurance not covering or only partially covering medical procedures. In 2024, 41% of US adults reported having trouble paying medical bills, resulting in medical debt. And medical debt is associated with other forms of financial vulnerability, such as being low income. You can see from this graphic that in a 2021 poll of people who do and do not have medical debt, more people with medical debt reported not having a rainy day or emergency fund, that their household would occasionally overdraw their checking accounts, that they felt as though they were just getting by, that they were contacted by a debt collection agency, that they use a pawn shop, and that they use payday loans. From the slide, know that medical debt is common and try to minimize it by making smart goals for savings and setting aside money for an emergency fund. There are also payday loans, also known as cash advances. These are short term loans, generally around $500 or less, that come due on your next payday. So if someone doesn't have quite enough money to make rent before the next payday, which is only 2 weeks away, they might take out a payday loan and then pay that as soon as they get their paycheck. However, these loans tend to be associated with high fees, which usually fall within a range of $10 to $30 per $100 borrowed, in addition to fees for being late on that payment. So, looking at this graphic, if someone took out a $300 payday loan with a $45 interest fee and a $45 additional late fee, within 1 month they would owe $90 for that $300 loan, not including that $300 they already owe. Within 2 months, it would cost $180, which is more than 50% of the cost of that original loan. And remember, this person didn't have $300 to begin with, so it's likely that they can't pay this back. At 1 year, they would owe $2,160 on this small payday loan. So these loans tend to be seen as predatory, where they tend to seek money from those who are financially vulnerable. There are also auto title loans, which are another type of short term loan. With these loans, the borrower uses their car title as collateral to borrow money, meaning that if they don't pay back the loan, the lender can repossess the car. These types of loans do require that the car is bought outright because, as you can imagine, it wouldn't work so well if the lender took the car as collateral, but then they had to make payments on it. And the typical auto title loan is only about $700, which means many cars are worth more than the money being taken out. This also means that if you can't pay it back, this is a really good deal for the lender if they were to repossess and then sell that car. And about 80% of people cannot repay their title auto loan without borrowing money elsewhere, leading to even more debt. Then there are rent to own arrangements, which are used to get consumer goods such as furniture, electronics, and appliances. The borrower rents the items so that they can try them out before they buy them. With this arrangement, the renter is paying monthly for these items with interest, and they typically pay until the total surpasses the cost of the item, or they pay off the remaining balance on the contract, meaning that they tend to pay more for those items in the long run. The borrower can usually return the item at any time if they don't like it, but they typically don't receive a refund for doing so. There is also a fair amount of risk associated with missing payments or returning items before the contract is up, resulting in additional fees. Therefore, it's typically cheaper to look at product reviews online and then buy that item outright. So, what happens if you take on more debt than you can manage? First, realize you are not alone. Many people have debt. You are not your debt, you are not broken, and you are not a bad person for having debt. But do not take on new loans or loans you cannot realistically pay off. And whether or not a loan is manageable might be a difficult conversation. Some people will borrow money to pay off other debts, which increases the debt owed. Know that you cannot borrow your way out of debt. Next, analyze what makes you spend. Are you spending more than what your budget allows? Do you overspend when you're with friends and family? Do you overspend when you're angry or sad? Budget analyzation and self reflection are key. And try to keep your debt to income ratio under 40% so you can set aside funds for an emergency. Things happen that we can't plan for, but we can try to prepare for them financially. And lastly, set SMART goals, which we have been talking about this semester in class. Make sure your financial goals and goals for repayments are specific, measurable, attainable, realistic, and time bound. There are four different ways to pay off debt, which I will just cover briefly because it's your job to seek out additional information about these in your assignment this week. First, there is the debt snowball method, where you try to clear the smallest debt first. This works well because it helps people remain motivated by seeing their debts disappear one by one. Then there is the debt avalanche, where you pay off the debt with the largest interest rate first. Financially, this is helpful because by targeting the highest interest rate, you save more money in the long run. There is debt consolidation, where you combine all of your debts into one large debt, so there is only one monthly payment to make. This is easier than keeping track of several loans at once. And lastly, there's debt management, where you work with a credit counseling agency who will correspond with each of your creditors on your behalf and arrange a payment plan that suits you, again, allowing you to simplify the task of repayment. And that is all I have for you. If you have any questions, please let me know.